All right, happy Sunday, everyone. I'm going to give it a couple more minutes for people to get signed in here. Okay, 2 minutes after 11. So I am going to share my screen here and we will jump into it. All right, perfect. So obviously, this is a Sunday webinar, free webinars. This is not intended necessarily to be a sales pitch, by any means. I come from a family of educators, and my dad's a teacher, mom's a medical professional, so I really like the educational part of this. So at the very end, after hopefully giving you guys a bunch of good info, things you haven't considered yet, there will be kind of next steps if you want to explore working together. But I'll save all the sales pitch stuff to the very end. So with that said, I'm going to jump into the presentation here. So, the very litigious world that we live in nowadays, anytime, we're talking about financial, anything financial related, got to have the disclaimers on here. So I'll trust that everybody takes the time to read the things on here. But basically, none of this is intended as investment advice. Everybody's got their own unique situation. You should always consult with, your financial professional, tax professional, all that good stuff. So with that said, drum roll here, what we're going to cover is the three costly mistakes that I noticed working with CRNAs. So On Point CRNA is basically a DBA name under my wealth management firm, Barnhart Wealth Management. And, quite honestly, I kind of fell into the niche of working with CRNAs. My wife's a CRNA. And as most of you know on the, the call here today, there's a ton of unique challenges that can be presented to CRNAs overall. So when we dive into a lot of the, I guess, the nuances, I'm sure many of you have come to see this already. So basically, we're going to break down. I see a lot of folks that balance their W-2 1099 work in the wrong way. They ignore the right 1099 retirement plan and just choosing the wrong business structure. So, I know there's a lot of Facebook groups and stuff out there regarding this. So hopefully we're going to get in more than just the top high level, like everybody should have an S corp or everybody should have a solo 401k, and really break down some of the variables there, and then ultimately how we work with clients and be able to triage kind of that money score for you. So first mistake, messing up the 1099 and W-2 balance, essentially overpaying on your taxes without realizing it. And what I see all the time here really revolves around the Social Security wage base. So this will become more important when we talk about S corps here in a minute too. But essentially for 2025, the first 176 grand and some change that you make will be subject to FICA taxes. So, if you're a W-2 employee, half of it, that 7.65, is covered by the employer. The other half is covered by you, the employee. After that, essentially only the 1.45 on each side is taxed for Medicare. So Social Security is that first 6.2 on each side. So what I talk to a lot of the folks that we work with that might be just dipping their toes into the 1099 world or complementing, maybe they make $30,000-$40,000 of 1099 income to complement the W-2 income. What's the optimal way to balance that? So rather than being, let's say 40 hours through your W-2 job, you might actually want to back off and elect maybe like a 0.8 status where we can, essentially eschew most of this Social Security wage base, get the hospital to cover half of it for you, and then you're basically in the money after that. So let's say you make $180,000 through W-2, and then that extra 40 grand you're going to make through 1099 work, it literally makes like 1 + 1 = 3 at that point, because you've already covered that Social Security wage base through W-2. Essentially, that $140 an hour 1099 job at that point really is maybe more like 150, because you're in the bonus essentially. So when you look at scaling back, some hospitals, every hospital really has a different criteria to balance this, right? What status do you need to have to still be able to maintain your insurance coverages, the match, paid holidays, time off, all that good stuff. And then ultimately what we would want to do is do an apples to apples kind of after tax bottom line hourly equivalent, because ultimately what it's going to open up for us as well is a Pandora's box of tax strategies. And that really, harkens back to the other things we're going to cover here, as far as retirement plans, write-offs, all that good stuff. All right, mistake number 2. And again, out of respect to time, because we got a lot to go through, we could do a whole 1 hour presentation just on mistake number 1. Same thing with number 2 and 3. So go over at high level, and then we'll have Q&A at the end. Mistake number 2, not choosing the right 1099 retirement plan. So I'm going to go over this pretty quick, but basically when you're 1099, you're essentially self-employed. You put on your self-employed hat. That opens up different types of retirement plans that you might be already used to through your W-2 job, like your 403B or your 457 plan. So the basic 3 choices are your SEP IRA. You're limited to up to 70 grand is the most you can put into what's called a defined contribution plan for this year, for 2025. You can only do 25% of your compensation. So, and that has to be aggregated with 403B income as well. Simple IRA, you're going to be capped out at 16.5. Both, to kind of jump to the bottom here, both of these are typically not the best fit because of lack of flexibility, lack of full dollars you can put in there. It's still an IRA, which means we can't do other things like a backdoor Roth strategy because you have pre-tax money outside of employer plans. The solo 401k preserves that ability, allows you to contribute much, much more, and hit the profit sharing contribution up to $70,000 in aggregate. So when I put all of these together, I will say, full disclaimer, a lot of custodians out there will offer what's known as, I call it a free off-the-shelf, like templated document. The IRS has, essentially like a boilerplated document that they approve for use with, various custodians. Because of that, like Fidelity, Schwab, Vanguard, they don't charge anything for these type of 401k plans. Honestly, it's a way for them to gather assets, right? Hey, here's this free account type, and you're going to put your money in it, and they make dollars, money just like a bank does, cash. So, and trading and all that good stuff. So what we do for a lot of our clients is draft a solo 401k that we actually have a third-party administrator preside over, and it's like a 30 or 40 page long document that allows a lot more creative tax planning. So this is what I mean by that. Put money in pre-tax. You can do this with the off-the-rack 401k plan too. So you can put in up to 23.5 as an employee, plus you can put 25 grand away, or 25% of whatever that net self-employment income is. I've got some mock scenarios that we're going to look at here in a second. You can also put money away on the Roth side. So I'm not going to read everything off of here, but there's some variations, in terms of where do you get the tax write-off on the front end or on the back end. But the big thing that a non-prototype solo 401k plan will offer is what's called a third type of contribution, an after-tax contribution. So many of you on this call might have heard of, colloquially, I call it the mega backdoor Roth strategy. Ostensibly, what we're able to do is get money into a tax sheltered account through a series of steps. We contribute to the after-tax account. We immediately, and the plan has to allow for in-service rollover. We roll that over to the Roth IRA. Ipso facto, we got the money into the Roth. There's some tax reporting and a lot of things that we can get into the weeds on, but at a very high level, why would we want to do this, right? So I've got a quick case study here on this mega backdoor strategy. This is one of the, maybe the biggest mistake I see is CRNAs come to us and they're not taking advantage of, this other type of savings vehicle. So, and shout out to my wife, who's also a CRNA, for helping me come up with these names at the top here for the case studies. So essentially, we got W-2 income for each of them. They're both 35 years old. They got their W-2. They complemented with some 1099 work. So each of them have the same W-2 income. Each of them have the same 1099 income. Nora saves her 33,688, and I'll save you on the getting the weeds. You have to subtract 1/2 of the self-employment tax to calculate this. I'm just trying to make it apples to apples to show you the value of saving into this type of account. Both people are saving the same amount. They make the same income. We're just changing the account that it's going to end up in and be invested within. And once it's in there, they're invested the exact same way. See the future value here. It adds up to $338,991 in both scenarios. And calls me up, 30 years later and says, "Hey, we want to buy this rental property. I need $330,000. Send me a check." I send her the whole check, right? There's no taxes that need to be taken out of it. Same thing for Nora. She says, "Send me a check," but the catch is we owe long-term capital gains on all the gains inside of their gains tax. So top capital gains rate between additional Medicare taxes, depending on the state you're in. In Michigan, it would be like another 4.25 on top of this. Long story short, this could be pretty substantial. And the key here is we didn't do anything magical investment-wise. They're invested the same way. We just changed the account that it's owned in. So if you are full-time 1099, sometimes 1099, you have an S corp, you have a sole prop, doesn't matter. You've got to be taking advantage of this mega backdoor strategy. All right, so quick scenario, like I just wanted to reflect, because I'm sure a lot of you on the call right now may be thinking, okay, how much could I actually put into this type of strategy? So I've got a client under 50 years old. They've got their LLC taxed as a sole proprietor. They didn't contribute to any other plans in the year. They made $200,000 after all their different write-offs and subtracting self-employment taxes to make it easy. So they max out the 23 grand pre-tax. They do the 25% profit sharing. Again, there's some nuance here in how we come up with this exact number pre-tax. And then whatever left over, we could still get up to the 70 grand. So they could do another $9,200 into this after-tax account that would be eventually rolled over to the Roth IRA. All right, so another scenario for those of you that might have an S corp. Same deal, 50 years old. The only thing we're changing is taxed as an S corp. They pay themselves $150,000 W-2 salary, and then their K-1 from their S corp, that dividend or the profit at the end of the year that you're bypassing the FICA taxes with, gets kicked out as the K-1. Any of the contributions to a solo 401k are going to be determined on the W-2 amount when you're an S corp. So same deal. We're trying to get up to the 70K, right? So still put away the 23.5 max pre-tax. This 23.5 also could be Roth. That doesn't change the calculations. The employer contribution, that's always going to be pre-tax. So we do the 25% of 150, and then what's left over could still be executing on this after-tax mega backdoor strategy. So to really quantify this, without again getting way too far in the weeds, in both of those scenarios, it was like 9 grand, right? So I want to be able to quantify for how many years um, we did this. So let's say you do this strategy for the next 20 years in your career. There's a ton of assumptions that I run through here, but basically, I've got all the sources and stuff down below. Again, this is not intended as investment advice or guarantee of future results. I just want to reflect the tax potential of something like this. S&P 500 since 1926, we almost have 100 years of data there, 10.63%. We also have some tax drag because the dividends that are kicked off from the S&P 500, if you just invest in a taxable brokerage account, you're going to owe taxes on those dividends every year. So just assuming, that qualified dividend rate. And then I just want to be able to quantify long-term inflation assumptions too. So 2 scenarios still here. We execute 9 grand a year for 20 years, grows to 254 grand if you just save it into a brokerage account. Annualized return after taxes, really because that dividend rate, the taxes owed on that dividends, down the line, can really cannibalize things. And then we also would have to realize those gains too down the road. Compared to the Roth IRA. So you can see we essentially keep that full still 10.63 because we don't have the taxes cannibalizing the returns. So ultimately, how much more are you left with after taxes? It's a big difference, even though I'd say quote unquote only 9 grand a year is being pushed into this. It makes a big difference over the long run. So you can see how if these numbers were long, like let's do 30 years because you're at the beginning of your career, let's do 30 grand instead of 9 grand. This can really move the needle in a major way. There's a ton of tax reporting things. Make sure you're crossing all the T's and dotting the I's, which we help with. But again, for purposes of this 1-hour webinar, I wanted to show you just the value of, this is kind of a big deal to be leaving on the table. So one more idea here. This makes sense for fewer and fewer clients. Really has a lot to do with age, personal goals, things along those lines. But again, I wanted to come up with some ideas that maybe you haven't heard of. So cash balance plan. So everything we've talked about so far is what's known as a defined contribution plan. The amount that you can contribute is written in the tax code. It's defined up to 70 grand. A defined benefit plan is a pension. The benefit's defined. Put in X amount, but down the road, you're going to get this income stream for your pension. So how does this really work in practice for CRNAs? So again, this would only make sense for full-time CRNA that's really trying to hammer money away pre-tax, maybe in like the last 5 to 10 years to retirement. So with that said, essentially what it allows us to do is push a ton more money pre-tax into this type of vehicle. Now it is a pension down the road, but when we terminate the plan at retirement, we have a trigger that allows us to then roll it over to an IRA. So you have a team of actuaries that have to define the benefit every single year based on your age, based on how much you're putting into the 401k, based on your income. There's a ton of different moving parts. So there are some, this could be a couple grand a year to administer a plan like this, but it would save you potentially a ton of money in taxes. I had a client earlier this year that she maxed out the 70 grand on the 401k between the combination of the different contributions. And then she was able to still do upwards of like another $145,000 pre-tax into this 401k plan. For some 1099 CRNAs out there where income, especially if you're single, you're 50 years old, you're trying to retire by the time you're 55, income's eclipsing, depending on your contracts, $500,000 a year, being able to shelter, half of your paycheck could save you upwards of 6 figures in taxes, right? So this could be a really big lever to pull, just knowing that there are some contingencies, how much you can put in there, the write-offs. Obviously you see here deductible as a business expense, but really there's some additional costs. There's some things you have to commit to because you can't you forfeit the flexibility, right, of being able to just shut it off and on and off like you can a 401k. So there's some nuances there, but it can be a major lever that we can pull. So mistake number 3, after talking about retirement plans here, choosing the wrong business structure. So I think this is like the hottest button issue out there, right? Like, how many do we need to have? A solo 401 or S corp? Do we need to have a sole proprietor? Either way, everybody out here should have an LLC or a PLLC, unless you're in other states where a PC is required. Then we're kind of forced to go the S corp route from a tax efficiency standpoint. But for the majority on the call here, it's going to be LLC, and then we have a tax decision to make. Do we want to be taxed as an S corp, or do we want to be taxed as a sole proprietor? So here's some things that we want to consider. How much income are you going to make? This is a part-time hustle where you're going to make 30, 40 grand. Probably doesn't make sense to go the S corp route. Really, this is only going to be for full-time 1099, travel CRNA type of work. So some things we got to think about. Additional workload and cost of the S corp. So without even talking about the tax differences, let's just talk about the costs first. Bookkeeping. Depending on if you're going to pay a firm to do your bookkeeping, we don't do bookkeeping because, quite honestly, it's more than straightforward for a lot of CRNAs out there. It's not like you're a coffee shop with 50,000 transactions a year, right? So a lot of the bookkeeping is very manageable. But if you are going to outsource this, it's be a couple $100 a month potentially. Either way, using a software like QuickBooks might be $25, $30 a month. Got to have an accountable plan that you keep track of on a monthly or quarterly basis, reimbursing yourself for certain things that you can't take a direct write-off for. And it's this whole other separate tax return. So there's some additional costs for that. Most firms will charge, maybe a couple grand more for an S corp, depending on the firm. What's the reasonable salary you're going to pay yourself? Payroll, if you're in multiple states, it usually does not make sense, even though the FICA taxes, there will be a savings there from going the S corp route. If you're going to have contracts in multiple states, especially depending on the states, if you're in, Massachusetts or Taxachusetts, some of these having like foreign entity and payroll departments and things open and closing, it can get really expensive and really just eat up that entire cost savings of the S corp. Now you're jumping through all these hoops and not even getting the tax savings. And one of the big things that I've noticed a lot of people miss is there's no per diem reimbursement. So you are able to write off essentially the meal allotment, whether you spend the money or not, right? The IRS, depending on by location, let's say it's $100 a day. Well, if you eat peanut butter and jelly sandwiches all day and only spend $2, still write off the 100, but you can't do it if you're an S corp, because you can't reimburse yourself if you're more than a 10% shareholder, which everybody on this call would be. You're probably the only shareholder of your S corp. So you can only take that per diem if you are, 1099, LLC, sole prop. So what we do for all of our clients every single year, run it side by side at the beginning of the year. So we get together in the spring, and in the fall, we run a tax projection as well. But in the spring, we put together your cash flow game plan and say, hey, should we make the election this year? Should we revoke the election from last year? Something that we always have control over. But a lot of times, just blindly electing it to save on FICA, one of the other things is it's going to reduce your Social Security amount too down the road. You're not paying as much into the system, which is a whole other conversation, whether it's going to be there or not. Regardless, if we look at the QBI deduction, so back in, 2016, Trump pushed through in his first administration this Tax Cuts and Jobs Act. They came and made these sweeping cuts for corporations out there filing a C corp tax return. And basically said, what about all the small mom and pop businesses? So they came up with this QBI, Qualified Business Income Deduction. So to make that even more of a mouthful, the QBI deduction reduction happens when you elect an S corp. So basically they said, in this example, let's say it's 300 grand through your sole prop, you could write off 20% of that income. So you get a $60,000 QBI deduction. Now it's a deduction, right? It's a write-off. It's not like 60 grand in tax savings because we'd have to multiply it by your personal tax rate. That's still huge, right? you go the S corp route, let's say you pay yourself $120,000 S corp salary and you have a $180,000 K1, just for an example. Your QBI deduction is 20% of a smaller number now. You don't get to take it on the entire 300. It's only on that business income, that 180K. So again, these are approximations. There's a ton of moving parts with anything the IRS comes up with. But just for an example, like, okay, we're jumping through all these hoops. If I'm going to jump through these hoops, the tax savings damn well better be worth it, right? So, and that's what we look at for our clients, every single year, because obviously, I mean, tax codes are going to change surely, a bunch going forward here as well. So, and I mentioned the Social Security benefits would be less because you are now, instead of paying 300 grand in the system, you're only paying 120 and getting credits for it on that. Ultimately, it's all going to harken back to what are your personal goals? How much do you want to put away pre-tax? With the sole proprietor, you would be able to base contributions, potentially a cash balance plan on this full 300 grand. Even if you did a cash balance plan in this example with the S corp salary, you would only be able to do it based on the full 120 from your salary, not everything else. So, like anything, right? We're pushing one lever, we're pulling another. So those are the three big mistakes that I see. Now, when I look at the way to, start triaging a financial situation, the way that I do that is through essentially financial vital signs. So, essentially the doctor-patient model, right, to use a medical analogy, is not a sales model, right? No doctor has ever been excited to sell a cast, right? They prescribe a course of treatment, and then it's up to you to follow it with the right guidance. So a good doctor, anyways, if you went in to see a doctor, is going to take tests and measure scores based on your personal health. And the first thing that they're going to do is start with your history, which we do with all of our clients, kind of how we got to where we are. And then they're going to take your vital signs and be able to benchmark those vital signs against your peer group and say, hey, your blood pressure is high. It's in the atypical range. We're going to address that before it becomes an issue for you down the road. So by monitoring the leading indicators of financial health, we're able to essentially practice preventative financial care in a sense and quickly triage any financial issues. So the way that we do this is through again, these series of vital signs. So if you look at the first row, we're going to talk about risk. The next row breaks down your cash flow. The next row breaks down your asset mix. And then the final row is summation, and that's your financial independence score. So to look at it in a new light, and I'm going to go over some of this pretty quick because, again, each of these slides we could talk about for a full hour. Talking about the first row here. I'm not going to read everything off the slide, but essentially what we're going to try to do is answer 4 questions. Are you taking the right amount of risk in terms of your overall investment portfolio based on your goals? And then ultimately, how much insurance coverage should you need to make sure that something can happen and blow up the whole financial plan? Are you using your income wisely is the next question. So all 4 of these, if we add them together, should add up to 100%. How much money you're saving, how much you're spending on living expenses, what's going towards debt, and ultimately the tax rate. This is one of the biggest things we can focus on and one of the bigger leading indicators of financial success because it feeds into the next row. If we are talking about savings, where should we be saving? If the proverbial pie chart is the mix of assets, right, stocks versus bonds, we also want to look at the type of account you're owning things in. Do we have too much in cash? Do we have too much in retirement accounts? Do we have too much in real estate? I have one client that has, $4 million invested with us that is all in pre-tax retirement accounts. There's not a lot of tax games we can play to replace his paycheck now that he's retired because it's all bundled up in pre-tax retirement accounts. We got to pay taxes on it to take the income out. Can't do things like Roth conversions and optimizing Social Security and realizing capital gain. There's all these levers that we can pull. We can't do it because he doesn't have the right mix of assets. And then ultimately, how much wealth do you need to make work optional? So, the esoteric, everybody needs to have, kind of pie in the sky retirement. Everybody, if you're 35 years old and you have $7 million, it's like, where do we even start today? So this is a very personalized way to look at retirement planning, and it can allow us to track progress over time without this abstract number that's only going to keep increasing as inflation goes up. So, and we'll talk more about this, but just to give you a flavor for how some of these scores work. If we look at, in this example, total income's 340, annual debt payments 122. All of our clients have really a personalized. This is like a very cookie cutter way to look at it. But obviously, CRNAs being higher income, different than somebody that might only have $150,000 of personal income. Certain things are going to skew the scores differently for them, right? So the way we break this down, and this is one of the reports we send out to our clients every month. Reading the vitals, right? So got your health indicator, target score, your score, and then that all kind of feeds back into your personal scorecard. So, and again, this is just an example, obviously. I don't have anybody named Anesthesia as a client, but this would be something that we talk about every single meeting, every time we meet with our clients. And the way that we get this score is through this really neat financial planning app that we use. So, much like in medicine, it's like the saying, what gets measured gets managed. This is our way of measuring things. So, I think those who measure their progress by the Standard and Poor's, right, the S&P 500 have a very poor standard, because I think for progress to be meaningful, it's got to be highly personalized. It's kind of like the track coach that says, hey, we're going to have you run the 400 and we're going to clock you, and that's going to be your personal best. And then from here on out, we're going to try to incrementally improve on that personal best. That's an effective way to measure personal progress. So this is the way that we do that. So for everybody on this webinar, and for those of you who signed up that might be watching this after the fact too, I'm going to email it out. I will offer to do kind of a free financial checkup. So if you take your phone, and I'm gonna email out this link after the fact too, if you're on a desktop computer. But take your phone, scan the QR code. I've timed it. It takes like 5.5 minutes. It'll be a series of questions. How much money you're going to make? How much do you have in cash? What's the balance in your retirement account? How much do you spend on your mortgage? Very high level. Don't feel like you have to put exact numbers in there. You can round them off. But then what I will do is I will send you back a 3 to 5 minute video kind of breaking down your financial scorecard and give you a couple areas to improve on. So I will say this, the last time I did a webinar, there were some issues with downloading this QR code. What's going to happen, you scan it, you'll create a username and a password, and then it'll send you a code to your email. You go back to the email, you put in the code just to verify you have connection, that you are who you say you are. And then sometimes if you're on an iPhone, it gets a little finicky. What you're going to need to do is click the bottom right corner of this. This is why I put the screenshot on here, and then click onboarding, and it'll take you through these 9 questions. So it is a lot easier to do it on a desktop computer, which is why I'm going to, after the webinar, I'll send out an email with a replay and everything. But that would be kind of the next step from here. So I'm going to flip over to Q&A, and I got to figure out how to do this on this app. So give me a quick second here. So we got comments. Okay, so no Q&A. Give it 30 seconds for if you guys are typing anything. And then I'm gonna go back to sharing the screen somehow here. All right, so no Q&A. Okay. Let me go back to presentation mode. All right. Okay, cool. So the last thing that I'm going to run through here is, and this looks a little weird. Let me. All right, new software. Bear with me. Okay. So last thing I'm going to run through here is going to be the one-page plan. So that this is my company, right? We're a small boutique financial planning firm here in Michigan. Got a CPA, got an assistant, but largely it's my company. I think to do this job the right way probably caps out at maybe like 150 relationships or so. Over halfway to that point. At this point, my goal really is to take on 150 clients. Probably like 90% of them are already CRNAs, and stop taking on clients. So the reason I say that is because when developing, in my mind, what an ideal relationship would look like with a financial advisor, I try to almost like look at it through the eyes of, my wife's eyes, right? She could not care less about a 1,000-page long financial plan. So when I think there is a place for that, but as an advisor, I think a lot of advisors try to create this complexity because that's what appeals to us. But I've learned most folks just want to know two things: am I on track, and what do I got to do next to stay on track? So when we meet, we essentially have a simple one-page financial plan that serves as the itinerary for the meeting. So I send this out ahead of the meeting, sure you're prepared. And then if there's really anything top of mind for you, we get it added to the docket ahead of time. That allows us time to research too. So essentially, we should be working towards goals. We should be those next steps to immediately get to those goals and then help you track progress over time. The next thing I want to run through here would just be the importance of tax coordination. So we prepare tax returns for our clients. So it's almost like the silo syndrome, right? Like a patient seeing multiple specialists who don't communicate. Financial and tax decisions are often made in isolation, and really they lead to missed opportunities. In a missed diagnosis, a lot of times can be just as harmful as a wrong one, right? So in taxes, specifically, failing to plan is just as costly as making a mistake. When I review tax returns, I very rarely even see mistakes because the software is so intuitive nowadays. Most accountants are really great at just putting numbers into boxes. The year's already over, not much you can do, right? Shoot, we should have done XYZ to save you X amount of taxes, but we can't because the year's already over. So we take a very proactive process and flip it on its head and make it a reactive process, make it a proactive process, really just trying to avoid missing opportunities. And we use some really neat software that can take a very complicated tax return that might be 80 pages long and boil it again down into one sheet that we run through. Looks good. Here's your projection at the beginning of the year. Sole prop versus S corp. We're always evaluating that. And again, we could talk for an hour just about taxes. So from there, in the spring meeting here, we're doing tax returns, and then we're also putting together a cash flow game plan for our clients. So this is obviously a very high level what one of those would look like, but essentially it allows us a very visual way to look at where your money's going. I am not the advisor that we need to break out like, hey, you're spending way too much on Starbucks. Like that is not me. I think I would not want to do that to my own wife, let alone my client. I think life's too short for that. What I do want to know is just the standard of living we're shooting for. Hey, if we had 10 grand a month, 12 grand a month coming in, we can cover all of our expenses. Well, then we can back into, all right, how much is left over that we can play some of these tax games with? So the idea here is, your money, our services. I'm not going to read everything off the slide, but essentially, we want to, help you put together a blueprint. I see all the time, if you were to build a house, the analogy I always use, the first step would be to go down to Home Depot, buy a bunch of 2x4s and start nailing them together, right? You want to meet with an architect to put together, hey, this is what we want the house to look like at the end. How many 2x4s do we even need? It's like the Dwight Eisenhower quote from D-Day, like plans are nothing, planning is everything, right? So life happens. We want to be able to adapt the plan because, quite honestly, as soon as we finish that plan, it's already out of date. The next thing we'd want to look at is grow it, right? So we also offer investment management service. The challenge really isn't to pick the best investment. The challenge is more to pick the right investment and the right investment strategy for you. At the end of the day, as investors, all we're left with is our after-tax and after-cost returns. So our investment philosophy really follows three key criteria. We want to own tax-efficient investments. We want to keep your costs low, and we want to own the right things in the right accounts. I want to put you in the best position to have the most amount of money in the long run. Pretty simple when you look at it through that, and it makes a lot of those other decisions a lot easier. Share it, right? There's estate planning coordination. A lot of these are kind of the spokes on the financial planning wheel. Ultimately, protect it. It's much better from a financial planning standpoint for us to prepare than to repair a financial plan. So ensuring against the things that can go wrong, allow us to invest for the things that can go right, tomorrow. So I used to have all my insurance licenses. I've let them go because, I think it muddies the waters. It's like, all right, Joe, you need a $2 million life insurance policy. Well, obviously that pays me more than a $1 million life insurance policy. It's just a really shitty way to start off a relationship. You're like, does Ben really have our interests, at best interest at heart here? So I do not accept commissions for insurance. We have a roster of guys we refer stuff to. But the reason I hammer on that is because with any of these decisions, taxes, investments, insurance, you will not have to worry about me recommending something you don't need because my compensation doesn't align with that, right? And obviously, taxes, big focus for the firm. Personal pride for me to keep Uncle Sam out of my clients' pockets as much as possible. Usually next question I get asked here is, what can I expect if we work together? So, from the beginning standpoint, we go through like an onboarding phase, getting all this stuff dialed in, but then we go into more of a maintenance phase where we should be able to hammer out a lot of this stuff in 2 meetings. My wife always jokes, you should tell people, it's kind of like, you got to make your semi-annual appointment with the dentist, you got to do it. I realize the last thing most people want to do is talk to their financial guy when it's 90 degrees out about, mutual funds. So hopefully there's a lot of behind the scenes work and we can really make the most of our time together and get all this stuff taken care of for you. So we do that in 2 semi-annual meetings in the spring, March or April, which is coming up here. We actually do the tax return preparation and we put together that annual cash flow game plan. And then in the fall, we do that tax projection to make sure we're not missing any opportunities. The reason I do it in the fall is because most of the year is over. It'll be a lot more accurate with only 2 months left in the year than 5, right? And then for W-2 CRNAs, or even 1099, you're usually in your open enrollment period. So making sure we got the health coverages, stuff like that all dialed in, help you make elections on that front. Every quarter, I send out net worth progress reports, investment performance reporting, and then I send out, 10, 15-minute video on here's the changes we made across portfolios over the last quarter, and here's our outlook and how we're positioned for the next quarter. Candidly, it saves me from having 100 of the same conversations, and allows me to really boil down the ideas in an easy, and then everybody can watch it when they want to. Every month, we have a different vital sign that we focus on, and it's really neat because I benchmark that. I work with so many CRNAs, and I've also learned CRNAs are a pretty competitive group. So a lot of times it's, hey, my savings rate's 18%. What's the highest savings rate of a CRNA that you work with? What's the top quartile of the CRNAs you work with? How do I stack up with my income compared to other 35-year-olds or my debt compared to other 35-year-old CRNAs? So there's some really interesting metrics that we can look at just using the law of large numbers that can almost gamify financial planning, make it less like, eating your vegetables, looking at some of this stuff. So then obviously life happens. It's like an on-call type of analogy. This would be unlimited access to me too. Hey, I got a contract I'm picking up on. We don't charge hourly, anything like that. So you're not limited just to that. Next question I usually get asked here at this point is how, this all sounds great, Ben, how do you get paid? So I am a fee-only fiduciary, which sounds like a bunch of financial jargon, but what that essentially means is I have to put your interests ahead of my own. Or to say it another way, I have to do what's right for you, which you would best for in your best interest, which you would think would be like common sense. Unfortunately, and the only reason I hammer on this is because the majority of advisors out there are not fee only fiduciaries. Odds are, your brother-in-law or college roommate that is an advisor does not do this. Meaning, I don't earn commissions. I don't have any incentives to push a certain type of product. Like if we want to use a Vanguard ETF or a Schwab ETF, or we want to hold the money at Schwab compared to things, it doesn't matter to me. It doesn't change how I get paid. So there isn't anything muddying the waters there. I don't get taken out to steak dinners because I sell certain types of annuities, anything. I have a lot of buddies in the industry that would cringe hearing me say that. There's a lot of great advisors out there under this model. But the reason I hammer on it so hard, financial advisors are the second least trusted profession in America, right behind ambulance chasing attorneys. So, and it's ironic working with CRNAs because nurses are the number one trusted. So I hammer on because there's a reason I started my own firm, and that's it. So that aside, how do I actually get paid? So I charge separately for financial planning. Charge $100 a month, very transparent retainer, a monthly fee. Cancel anytime, like a gym membership, and then we don't charge for your personal tax return. So I do not charge for that. It's covered by the $100 a month fee. And then for the investment management side of things, I charge 0.1%, a tenth of 1% per month of any assets under our management. So that doesn't include, because this is usually a question I get, that does not include your equity in your house or cash at the bank. It's just money that would be in managed accounts. Okay. The other thing I want to be very explicit about, we do not unbundle these services. The reason why is because great financial planning and great investment management, in my mind, and the whole reason I started my firm to begin with, are inseparable. So I insist on doing it this way because my goal is to do the best work possible for my clients. And that requires us to manage the full financial picture. For example, it's not just about how you fund an account, which is some of the strategy stuff we've talked about, but also how it's invested. Every decision is going to impact the next, right? So tax planning, cash flow, risk tolerance, insurance, investment strategy, all of those things got to be coordinated for optimal results. On top of that, for clients with over $1 million invested with us under our management, we waive the $100 a month financial planning fee. So that basically just includes us doing all the financial planning for free, doing their tax return for free. The reason why is because at that level, our interests are completely aligned. Your financial success directly benefits both of us. I don't need to nickel and dime my clients. My goal is I want to have a long-term relationship. So our contract, either one of us can fire each other at any time for any reason. You're not held hostage or anything along those lines. It's very straightforward as far as that's concerned. So, like I said, goal is not to nickel and dime clients, really more so to create a financial strategy that works holistically. Proverbial kind of one-stop shop. So to more over to the same point, we don't do hourly financial planning. We don't do a one-time financial plan. It's really more if you're looking for a financial planner or a partner really who offers an integrated approach, we would be a great fit for you. So the rationale behind that, and the only reason I hammer on this is because I did one of these webinars earlier this year, and I had 20 people reach out that wanted hourly consulting and that sort of thing. The reason that goes against how I've structured things is because financial planning is not a one and done exercise, right? It requires ongoing adjustments, implementation, monitoring, that sort of thing. So if you do have an S Corp, the other thing I would add too, if you do have an S Corp, there could be a potential separate fee. I'd want to review kind of how you have stuff set up. because basically that's a whole separate business tax return outside of the personal filing. So we can talk about that if we want to move forward to that point. All right, so shout out to my wife for the CRNA jargon on here. I don't even know what half of this stuff means, but I'm sure many of you do. So basically, where we are today, if you want to explore working together, and this is where like the sales pitch part comes in. If you want to put on my salesman hat here, if you do want to explore working together, pretty straightforward process. We've already went through a lot of the nuts and bolts stuff. But basically, I'd want you to grab a meeting on my calendar, download the Elements app, to go through that questionnaire. That'll be the first step that we'll go through anyways. And then, essentially we get back together. I put that one-page financial plan, and essentially you'll have three choices at that point. Any of our recommendations, you could take the recommendations, and like my fingers are crossed here that you want to do this. But you could go implement them on your own. The second choice would be to go find someone else. You could hire another professional to help you execute the plan that we put together. Or the third choice, and albeit this is my personal favorite, you'd partner with our team to help kind of bring the plan to life and start to implement things. So the bottom line here is hiring a professional, me or anybody else, only makes sense if the value you're going to receive exceeds the fee. That's the standard. That should be the expectation, and that's what we deliver for our clients. Otherwise, I wouldn't have much of a business. So, quick note on capacity. This is not like a sales thing. Just because we are so close to tax season, to maintain the level of service that our current clients expect, I'm only going to onboard 10 more clients for tax returns for this year. So. During this tax season. So after we get to 10, there's quite a few people that are, have signed up for this, maybe not on the call right now. But after we get to 10, we'll probably just start like a wait list for after tax season. So isn't really about exclusivity. It's more about ensuring, every current client gets the time and attention that they pay us for. So, all right. Last slide here, and then I'm going to go check the Q&A. Let me pull that back up, just in case any of you want to grab that again. Yeah, Nick. So fees start at yes, that would be annualized. That 0.1% per month is annualized. So yeah, that would be 1.2%. And then it goes down significantly. So based on the AUM. So basically every $1 million, there's about a 20% discount. So it goes 1.2, 1, 0.8, 0.6, all the way down to 0.4%, depending on how much money you have invested with us. Rationale there, like I said, our interests are completely aligned at that point, and it's more, you get to that level of net worth. It's more about holding on to what you already have than trying to run up the score. So I get economies of scale through software and trading and stuff like that. So I just basically pass that stuff along. Let me flip over to here. Okay. I think that's the only question that came in was from Nick. All right. I am going to send this stuff out. So I'm sure I'll have a few people that sign up for the Elements thing. Last time I did this, I had like 30 people sign up for it all at once. So over the next week, I'll get you those 3 to 5 minute videos sent back. I'm going to send out an email with the recording of this, and then the link to actually go through the Elements process, as well as a link right to my calendar. Again, if you are interested in exploring this, working together, just because of the capacity with tax season, I would say to not delay. It'll probably just be like first come, first serve type of thing. Again, that's not me being salesy by any means. I just don't want to overwhelm the folks I have on the team already. So that would be kind of next steps from here. But otherwise, we're almost right at that hour. So hopefully a ton of good info, things you guys might not have thought of. I'm gonna send all this stuff out ahead of time or after the call here. I'll hang around for a couple more minutes if just for questions coming in. But otherwise, hope you all enjoy your Sunday, and I'll talk to you all soon. Janisha, I got your comment here through Facebook. Yeah. So if you go to my website, Janisha, you can just shoot me an email, and I'm gonna send all this stuff out to people that like subscribe through the website for the webinar instead of directly through Facebook, because obviously I don't have your email through Facebook. But let me see if I can just pull that back up for the QR code right now. But otherwise, I'll send out the replay of this. Figure out how I got to do that. All right, bear with me. I'm trying to figure out how to share the screen here. Share screen. There you go. Hallie, do your fees differ for married filing jointly? No, they don't. Nope. All right, I'll stick around for a couple more minutes in case anybody has any other questions here. All right, no more questions coming in. We're right at the 1 hour mark. So again, I'm going to send after the fact here, I'm going to send out the webinar to everybody. I'll include the link to the element stuff. Other than that, hope you all enjoy the Sunday, and hope to talk to you all soon. Take care.